If you want to understand why the housing market feels impossible today, stop staring at the house and start staring at the money. Most people still talk about housing as if the whole game is price, per square foot, granite countertops, school districts, and whether the seller is asking too much. That is the language people use when they are looking at a house. It is not the language you use when you are trying to understand a market. Markets move when incentives move. They move when financing changes. They move when the buyer who used to be strongest becomes weaker and the seller who used to be patient becomes forced. That is what is beginning to happen. Now, for years, many Americans believed the housing market would stay tight almost by default. They saw low inventory. They saw homeowners locked into old cheap mortgages. They saw rents staying high. They saw the dream of homeownership getting delayed for younger families. From that, they concluded that prices had nowhere to go but up. I understand why they believed it. A lot of the conditions that kept housing elevated are still here. But the market does not have to collapse for power to change hands. It only takes one thing. Supply has to stop being patient, and the most dangerous supply in any market is not emotional supply, it is institutional supply. I have spent my life watching what happens when the crowd explains a market using the wrong variable. In stocks, people confuse price with value in business. They confuse growth with strength. In housing, they confuse sticker price with affordability. That mistake alone has ruined the judgment of millions of otherwise intelligent people. A house did not simply get more expensive because the number on the listing went up. A house got more expensive because the monthly burden got crushed under a different cost of money. Take a plain example in 2020, a median house priced around $328,000, financed with a cheap mortgage near 3%, could leave a buyer with a monthly principal and interest payment around $1,100. Fast forward to this new reality, the same broad category of house is now closer to $420,000, and the mortgage is not remotely close to 3% anymore. It is around 6.5%. Suddenly that monthly payment is not $1,200. It is not $1,500. It is around $2,200 before you even start talking about the rest of homeownership. That's put us apart people still do not absorb. The house did not become a little more expensive. The carrying cost became a different species. The taxes are based on a more expensive property. Insurance is tied to a more expensive property. Maintenance does not disappear because rates are high. Utilities do not care that your lender already took half your breathing room. So while a family may look at the headline and say housing prices rose roughly a quarter from where they were, the real burden of ownership has, in many cases, doubled. A buyer does not live inside a listing price. A buyer lives inside a monthly payment. That is the first mechanism you have to name correctly. I call it payment shock disguised as price appreciation. Once you name it correctly, the whole landscape changes. You stop asking whether sellers are stubborn. You start asking whether buyers can carry the load. You stop asking whether home values are still supported by old comps. You start asking whether the next marginal buyer can survive the financing. Markets are not set by the average owner sitting happily in a house with a cheap old mortgage. Markets are set at the margin, by the next transaction, by the next buyer, by the next seller who must move, by the next lender who tightens, by the next fund that needs cash, and that is where the story gets interesting. A lot of people were hoping the affordability crisis would solve itself through lower rates. It was a simple fantasy and therefore a popular one. The Federal Reserve would cut aggressively, mortgage rates would fall, monthly payments would come down, buyers would come back, everyone would exhale. It sounds clean. Most rescue stories do. The trouble is that macroeconomics rarely rescues people on schedule. When oil rises, inflation gets harder to kill. When inflation gets harder to kill, central bankers become less willing to cut. When the central bank cannot cut, long rates stay heavier than families hope for. Then the buyer who is waiting for relief finds out relief may not be coming when he expected it. And the longer that happens, the more strain moves through the rest of the financial system. This is the second mechanism, I call it, delayed rate mercy. Most people think higher rates merely slow buyers down. They do more than that. They move pain through every lever that was built on cheap money. They expose business models that only worked when capital was abundant. They squeeze companies that borrowed assuming rollover financing would stay easy. They reveal which assets are owned by patient capital and which ones are owned by capital that only looks patient until the refinancing window closes. That distinction matters enormously in housing because not all owners are the same. There is a giant difference between a family that bought a home to raise children and a financial machine that bought thousands of homes because the spread looked attractive when money was cheap. One owner sees a home as shelter, memory, identity, routine, and maybe a very long hold. The other sees a home as yield, mark, occupancy, financing cost, and asset rotation. One seller waits because moving is emotional. The other seller waits only until another division of the balance sheet starts bleeding. That is where many people are still not looking. They keep asking whether the homeowner down the street will panic. I am much more interested in whether the institution across the country will be forced. The public spent years watching institutional investors step into housing and concluded that this was simply a permanent new support under the market. They saw large firms buying single-family homes. They saw portfolios scaling. They saw competition become harsher for ordinary families. They saw cash offers and quick closes and assumed the institutional bid would always be there. That assumption may be one of the most expensive mental shortcuts of this entire cycle. A large institution is not strong because it is large. It is only strong if its funding is sound, its liabilities are manageable, and its other businesses are not pulling cash away from the very assets you think are protected. The public often looks at a real estate portfolio and imagines a fortress. I look at the funding chain behind it and ask a more useful question. What happens when the fortress is asked to pay for damage happening somewhere else? Now we reach the third mechanism, and this one is the hinge. I call it balance sheet contagion. You do not need the house itself to be broken for housing to weaken. You only need the owner of the house to have another problem. That is what ordinary people miss in every cycle. They think the forced sale must come from the same asset. It often does not. It can come from the creditor. It can come from the sponsor. It can come from the business next door on the same corporate structure that suddenly needs liquidity. If a large financial institution is under strain in one area and it also owns real estate in another, real estate may become the thing it sells, not because housing is its worst asset, but because housing is the asset that can still be sold. That is how pressure spreads in the real world. You saw versions of this logic in many past market breaks. Fine assets were sold to cover damage elsewhere. People watching only fundamentals could not understand why prices weakened. They said the asset looks good, it is occupied, it is still producing, it still has value. All of that can be true. But when the owner needs liquidity, value becomes less important than convertibility. So, if you want to know why the housing market can flip even without a classic foreclosure wave, there is your answer. Supply does not have to come from desperate families. It can come from institutions whose patience expires because their capital structure changed. And when institutional supply comes, it behaves differently from homeowner supply. A homeowner might test a price, hesitate, pull the listing, rent the house out, or decide to stay another 2 years. An institution with a mandate, a redemption queue, a financing problem, or a strategic shift can become much more disciplined on one side and much more ruthless on the other. It can decide that being first out matters more than maximizing every dollar. It can accept that clearing inventory now is worth more than hoping for a better market later. It can move from net buyer to net seller not because it lost faith and shelter, but because it lost flexibility and capital. That single transition matters more than 1,000 hot takes. When a powerful buyer steps back and a potentially motivated seller steps forward, the conversation changes from scarcity to negotiating leverage, and negotiating leverage is what buyers have been starved of for years. I want to pause there because this is where the identity flip has to happen. For a long time, the ordinary American home buyer has behaved like prey in this market. He saved, he waited, he lost bidding wars, he stretched his budget, he watched cash buyers move faster than he could, and he was told to be grateful for any chance to overpay with a loan that already looked punishing. That is not an investing posture. That is a scarcity posture. But the market can turn in a quieter way than people expect. It may not announce itself with screaming headlines. It may not begin with a dramatic crash. It may begin with more stale listings. It may begin with institutions reducing purchases. It may begin with one fund selling in a few metros. It may begin with weaker sellers cutting first while stronger sellers hold. It may begin with buyers realizing they can ask for repairs again, ask for credits again, ask for time again. That is how power returns. The buyer stops being the hunted and becomes the underwriter. That is the identity flip. You are no longer supposed to show up grateful that someone will let you borrow too much money to buy too little house. You are supposed to show up measuring durability. You are supposed to ask which seller needs speed, which neighborhood was inflated by financial demand rather than local household formation, which price was built on cheap money rather than enduring utility, which cap table behind the asset may matter more than the kitchen backsplash. Most people do not think this way because they were trained to treat housing as a sacred emotional object. I have nothing against the emotional value of a home. It matters a good home can anchor a family, stabilize a life, and improve decision making in ways spreadsheets never capture. But the market itself does not care about your sentiment. It clears through financing, inventory, and urgency. So let me give you the full chain as I see it. Higher rates already broke affordability for the marginal buyer. Higher oil and inflation risk make rate relief less certain. Reduced rate relief keeps pressure on businesses financed for a cheaper world. That pressure intensifies stress in areas of finance that are sensitive to defaults and refinancing. Institutions facing stress in one line of business look across all holdings for liquidity. Real estate, including single-family portfolios, becomes part of that liquidity conversation. Once institutional buying slows and institutional selling rises, the supply picture changes. Once supply changes in a market where the ordinary buyer is already stretched, prices do not need to collapse to lose momentum. They only need to stop being protected. And once the market stops being protected, leverage shifts. That is the total mother line. Now, if you are a homeowner, you should not listen to this with panic. Panic is what people reach for when they do not have a framework. I am not interested in panic. I am interested in position. A primary residence is not a ticker symbol. It is not something you should trade emotionally based on every macro twitch. If you have a fixed rate you can afford, stable income, and a house that serves your life well, you do not have to turn your living room into a war room every time another forecast comes across your screen. The mistake would be different. The mistake would be pretending that home equity is a bottomless ATM because the number on a real estate website went up. That behavior was always foolish. In this environment, it can become lethal. Home equity is not cash until it is realized. It is a shadow figure attached to market conditions, transaction costs, and the willingness of a future buyer to accept your assumptions. When people borrow aggressively against that shadow, they create a second layer of fragility. Then, if prices soften even modestly, what looked like comfortable breathing room can vanish. A 10% decline does not sound dramatic in conversation. It can feel very dramatic if your household spending already leaned on the belief that your house was a permanent upward escalator. That is another mechanism worth naming. I call it phantom wealth dependency. It is one of the oldest mistakes in finance. People capitalize unrealized gains into current lifestyle. They do it with stocks, they do it with businesses, they do it with homes. They see an asset rise and then begin spending as if the rise is earned, permanent, and liquid. Then the market reminds them that none of those things were guaranteed. So if you own a home, the correct response is not fear. It is sobriety. Protect your fixed financing if you have it. Keep liquidity. Do not lever your lifestyle against imaginary equity. Treat the home first as a place to live and only second as a balance sheet item. The less you need your house to perform miracles, the safer you are. If you are a buyer, your lesson is different. Do not buy because you are afraid someone else will buy first. Do not buy because people told you housing only goes one way. Do not buy because you are trying to prove adulthood to people who are not paying your mortgage. Do not buy because you think a lower rate is guaranteed to bail out a bad purchase. Buy when the payment fits, the asset quality holds, the location has enduring demand, and the terms leave room for real life. Buy when you can survive not only this year, but a year of inconvenience, a year of surprise expense, a year of job change, a year when the market does not hand you appreciation on a silver platter. That is not a timid standard, it is an investor's standard. And if the market does soften because institutional supply enters at the same time, buyers are rate constrained, then patient families may finally receive something the market has denied them for too long. Price discovery, negotiation, optionality, the right to say no, the right to compare, the right to demand terms that acknowledge risk. The right to buy from a seller who needs them more than they need the seller. That would be a healthier market than the one we have been pretending was healthy, simply because prices were high. People often mistake a market that refuses to clear affordably for a strong market. It is not. Sometimes it is just a market distorted by financing conditions, policy expectations, and aggressive non-traditional buyers. A strong market is one where end users can participate without self-destruction. A strong market is one where financing does not require fantasy. A strong market is one where prices are supported by the lives people can actually live, not just by the balance sheets of actors who may reverse course. That is why I say the market is not merely expensive. It is brittle. Brittleness is what comes from stretching something too far while pretending it is solid. Now let me take you one level deeper, because this is where the long-term investor has to separate himself from the commentator. Everybody wants to know whether prices go down 10%, 15%, or whether some hot city gets hit harder than another. I understand the curiosity, but those are second-order questions. The first-order question is where the foreseller might emerge and where the real end user still exists. Some places were inflated more heavily by institutional demand, speculative demand, or migration narratives that got ahead of themselves. Some places still have durable local employment, constrained useful supply, and household formation that can support long-term value even if prices wobble. Some submarkets can withstand softness because they serve real people with real incomes and ordinary needs. Others were levitated by flows that can reverse faster than the public expects. That is why broad national averages help less than people think. Real estate is local, but capital stress can be national. When national capital stress starts touching local housing, the winners and losers will not be decided by a slogan. They will be decided by who was real and who was rented by the cycle. I like real estate precisely because over long periods, people still need somewhere to sleep, raise children, and live ordinary lives. Shelter does not go out of style, but that does not mean every price is wise, every deal is protected. For every cycle must reward the impatient. In fact, real estate can be one of the cruelest teachers because it uses leverage to magnify both good decisions and foolish ones. A sensible property bought with room to breathe can stabilize a family for decades. A stretched property bought to satisfy envy can punish that same family for just as long. So when I think about housing now, I do not start with whether I am bullish or bearish. Those are television words. I start with a protocol. First, I ask whether the payment survives the rate environment we actually have, not the one people wish for. Second, I ask whether the asset is being priced by an end-user market or by institutional behavior that may be temporary. Third, I ask whether I am buying utility, cash flow, or just hope. Fourth, I ask how much of the thesis depends on refinancing, appreciation, or rescue. Fifth, I ask whether I would still be comfortable owning the property if the market did nothing flattering for 5 years. That protocol keeps you out of a lot of trouble. You do not need to be a prophet if you are disciplined. You do not need perfect timing if you refuse bad terms. You do not need a dramatic crash to get a better opportunity. You only need the ability to recognize when the market's old structure is weakening and when your own standards must harden instead of soften. That is what I think many people still do not understand. They keep waiting for a cinematic event. They keep waiting for one giant bell to ring so they can say, now the flip has begun. Markets rarely grant that luxury. They leak information slowly. First, the narrative wobbles, then the buyer weakens, then the strong bid becomes selective, then the overleveraged actor changes behavior, then inventory behaves differently, then pricing power drifts, then the public finally notices what already happened in slow motion. That is the housing market I believe you need to prepare for. Not a fairy tale recovery powered by easy money, not an apocalyptic collapse where every house is half off, a transfer of leverage, a repricing of patience, a market where who must sell matters more than who wants to buy, a market where the cost of money matters more than the memory of old comparables, a market where institutions can stop acting like the floor and start acting like the ceiling. And in that kind of market, character matters. If you are reckless, you will still find a way to lose. If you are vain, you will buy too early because you cannot tolerate waiting. If you are lazy, you will confuse headlines with underwriting. If you are over-leveraged, a mild decline will feel catastrophic. But if you are liquid, patient, and unemotional, you may discover that the market finally begins to reward behavior that should have been rewarded all along. There is one final thing I want to leave you with because this is where money always becomes philosophy, whether people like it or not. A home is one of the few assets people are encouraged to romanticize and finance at the same time. That combination makes human beings especially vulnerable. They stop distinguishing desire from capacity. They stop distinguishing status from shelter. They stop distinguishing a good life from an expensive monthly obligation. Then when the market turns, they say the economy betrayed them. Often the economy merely enforced arithmetic they did not want to face. The arithmetic is simple, even when the headlines are not. If the monthly burden doubles and income does not, affordability breaks. If affordability breaks and rates stay heavy, demand weakens. If demand weakens and supply rises, leverage shifts. If leverage shifts and phantom wealth was supporting behavior, pain spreads. If institutions need liquidity, they do not ask whether the public is ready. They sell. That is the test. Not whether the housing market can still produce another exciting headline. Not whether some guru can tell you the exact month of the next move. The real test is whether you have built a life and a balance sheet that can survive a market where the old assumptions no longer protect you. Can you buy without needing immediate appreciation? Can you own without borrowing against fantasy? Can you wait while others are forced? Can you tell the difference between a house that improves your life and a purchase that merely flatters your ego? Can you underwrite the payment, the seller, the location, and the cycle all at once? That is the terminal choice in front of people. Now, one path is to keep repeating the slogans of the last housing cycle and hope yesterday, as conditions come back to rescue tomorrow. As decisions, the other path is to accept that money has changed, power is moving, and the next great advantage may belong not to the loudest buyer, but to the calmest one. That is usually how it works in markets. And in life too.